you're ready.
Okay, I'll welcome people again to this meeting of the Finance Strategy and Management Committee. Item number 1, apologies for absence.
We have apologies from Councillor Sarah Miller and Councillor Dave Eggleton, and Councillor Michelle Thomas is substituting for Councillor Eggleton.
Okay, thank you. Item number 2, declarations of interest. Do we have any on tonight's business? I see none. Item number 3, public participation. Do we have anyone registered to ask a question or to speak?
Not that I'm aware of, no.
Okay. Item number 4, to approve the minutes of the 15th of September. Are there any items of fact, or can I propose? Are you proposing, Councillor Plant? Yep. Can I have a seconder for that, please?
Yeah.
Councillor Gavershak. All those in favour? Okay. Item number 5, finance, to receive the dashboard papers, management accounts, summary of SIL, bank reconciliations, and summary of payments. Are there any comments or any of those, or can I have them proposed en bloc to be received? Councillor Hamilton.
Yeah, I just wanted to note the dashboard papers. I can see the progress being made in terms of what the town clerk's been doing with furlough. And I would ask you, Mr. Chairman, if we could have an item under part 2 for under staffing. I know we got quite a lot to discuss in part 2 already, but I think there's a couple of things that I'd like to bring up in terms of furlough, and I think it's probably right it should be done in part 2.
By part 2, you mean in confidential session?
Yes.
Yeah. Okay. So you want to defer?
Just at the end, we'll just have a discussion at the end. I'm quite happy to note the dashboard papers as is, but if we can just have that discussion at the end.
Do you have any specific questions?
Yes, but I'll do it in part 2. There's a reason for it.
Okay.
All right.
Okay, I'll bear with you.
It'll only take a couple of minutes, Ian, honestly.
Okay, in that case, we'll do that between item 9 and 10.
Okay.
Okay. Apart from that, are there any other issues, or can I propose that we receive all of those papers? Councillor Plant, I think did that. Councillor Gavershak seconded again. Does anyone wish to speak, or can we go to the vote? Okay, all those in favour? Okay, thank you. Item number 5, little 2, to receive reports on the performances of the council's investments and to approve the council's investment strategy. So at this point, we welcome Nick McGregor and Charles Heaton. If you'd like to switch yourselves back on. Have you tossed a coin to see who kicks off?
We haven't, Ian, but only in terms of the running orders in the presentation pack. I think I go first, but only.
Let's stick with the agenda. Yes, that sounds like a good idea. So
Charles,
if we
turn to page 66. And in fact, move on to page 67, because that's more instructive, and that is the long-term performance of the Henley-on-Thames Town Council portfolio, the red line compared with the various indices and benchmarks, and of note, the peer group comparison, which is the Asset Risk Consultants balanced portfolio, the pale blue line at the bottom. And from the chart on page 67, you can see the good long-term performance of your portfolio. Then turning to page 68, we can see that in numerical form, and over that period from January 2009 to September 2020, the portfolio has increased by 156% in total return terms, and that is an annualized 8.36% return. Compared with the benchmark, which is the retail price index plus 3.5% per annum, that has returned an annualized basis of 6.27. So you're comfortably ahead of your benchmark. And then as the analysis against other assets represented by the Wealth Managers Association income total return benchmark, that has returned 7.15% per annum. So again, you're just over 1% per annum ahead of that recognized benchmark, and similarly, very much ahead of our peer group, which is made up of about 85 different city firms that present their performance data. The second part of page 68 looks at the income evolution, because that's clearly very important to you. And I'd make two observations. One, you'll see in the year to September 2019, there was an acceleration in the income received to £100,000 compared with the forecast. And you might say, why is there such a differential? That's because we were able to capture some special dividends payments and some judicious use of timing with selling things that had gone ex-dividend and then buying other stocks that had come the dividend. And so the income level was quite high in 2019. Of course, the reverse is the case now. It's the opposite, in that income levels have dropped very sharply, particularly in the UK. And in the case of your portfolio, the income level is down 22% in the period to end of September. UK companies overall have cut dividends by about 45%, less so in other markets, and your portfolio has been very much protected from such a savage fall by its diverse asset base in this very difficult phase. Turning to page 69, this is a summary of the portfolio in the year to 30th of September. You can see that it's been a difficult year. We're down 4.2% in the year to date, and over the period in question, the portfolio is down 1.1%. So somewhat behind the benchmark in the shorter term, which is not entirely surprising with what we know about the stock market collapse in March, April, and May, which is shown in the chart in the right-hand quadrant. I think equally instructive is the bottom left quadrant, showing where we have outperformed relatively in UK equities and outperformed in international equities. They're pretty evenly balanced, with about 31% in both asset classes. And it's very striking that the UK market has been so weak, down 10% in this period, as opposed to the international stocks, which are up 9% in this period. And thankfully, we have had a good proportion of the assets in international stocks, which have held up and performed very well. The other feature to note is the weakness in the property sector, down 27% in this 1 year period. Turning then to page 70, I've described it as, or put the headline as, the search for income, because obviously that is very important to you and was stated in the investment strategy update that we received, notably the objective for an income return of £148,000 between what I produce and what Nick produces. So income clearly is very important to you. And so I'm really majoring on the fact about the timing of the withdrawal from the ESG bad sectors, which have been identified in that strategy document, to explain perhaps why you might consider I've been rather slow in working towards the zero holdings in tobacco, chemicals, mining, oil and gas, and gambling. And that's simply because of the magnitude and the speed with which dividends were cut in the year, starting in March of this year. And dividends, as I say, fell very, very dramatically. And I thought it would have been imprudent to have cut out those sectors which are classed as bad because that would have been quite a dramatic fall in your income by circa £9,000 worth of income. And that would have been considered imprudent to do that reduction in those stocks, those sectors too aggressively. However, it should be noted I have been able to find replacement income in clearly classed as very good companies in terms of the ESG criteria, things like Sequoia Economic Infrastructure, the Renewables Infrastructure Fund, and the SDCL Energy Efficiency Trust, all of which are yielding around 5 to 5.5%, and therefore essentially maintaining the income. But finding suitable replacements for all those things that are falling into the bad category is quite difficult, and it will take time to move out of those bad sectors into other names. Turning then to some specific things, I've picked three stocks just to highlight how complicated this process is. So Halma, which you've got in your portfolio, has done brilliantly for you. Rate of growth in the income from it, 5% per annum, but a very low yield of 0.7%. Absolutely the sort of growth stock we want in the portfolio, but it doesn't deliver enough income for you. I then highlight something which I've classed as bad, which is a fixed interest fund. Now, you wouldn't think that a fixed interest fund would see a declining level of income, because by definition it's classed as fixed income. But actually, because bond yields have collapsed over the last year or so, even the fixed income stocks are beginning to cut their income. So balancing out the loss of income from some of the equities, the loss of the income from some of the fixed interest stocks, it has been paramount to try and keep the level of income up to meet your requirements for the 148,000 a year. And then we go to the ugly, which BP, which clearly doesn't meet either the environmental criteria or the income criteria, with a 34% reduction in the dividends. So it's been a really challenging time in which to manage portfolios with this destruction in income flows due to COVID and the onset of a very sharp downturn in economy. I then just throw into the mix, and I would urge you not to throw the baby out with the bathwater, because I know chemicals are falling into the bad category. But here we've got a company called Croda in the portfolio, which actually fits many of the criteria of being an extremely good business for the environment, and incidentally has just benefited from Pfizer's announcement about the vaccine that was declared yesterday, as it provides some of the chemical input into that vaccine. So I would urge you to consider as a committee whether in fact all the criteria that we're looking at in terms of ESG criteria really is what you would like. Then looking at the mix of the assets, we were given a target of no assets to be in the severe category, and the latest analysis shows that we have adhered to that policy, and overall the risk category is medium and a weighted average of 22.5, which is better than the overall stock market rating for ESG risk scores. But you'll see there are several stocks that fall into the high category, and it's worth noting that following the rally in oil stocks that we've had in the last couple of days, we have now exited BP to help that transition towards a better environmental scoring. Looking at the collective funds in your portfolio, I think it's fairly obvious there are some unit trusts and collective funds which score badly. So names like Henderson Far East, which has a lot of its exposure in old-fashioned heavy industries, in Australia, mining in particular, that almost certainly will be a candidate in time to go out of the portfolio. But overall, the collective funds in the portfolio, I think, score reasonably well on the ESG criteria, which we are now looking at very carefully. Moving now to what's going on in markets, clearly three key factors influencing markets: both monetary stimulus, fiscal stimulus, COVID, which we probably are more up to speed with than on any other factor, as we get a daily dose of what is going on in the world from the news, and then politics, which we know the results there. So I think perhaps the most interesting thing, what have been the policy responses to the crisis? Fiscal policy has been very, very stimulative, huge injections by governments, and you can see on page 76 the extent from all the major economies, save for China, who have not been at all aggressive with the stimulus, but Germany in particular very strong, and other European countries and the US, etc. The global monetary response has been equally very strong from central banks, printing money, quantitative easing, and we saw at the end of last week our own Bank of England injecting a further 150 billion to stimulate the economy. But perhaps the most, so that's the policy response from governments and central banks to stop a worldwide recession stroke depression taking hold. The markets clearly have been dominated by the acceleration in COVID infections, the details shown on page 78, and I've titled it, "A Vaccine Can't Come Soon Enough." Well, of course, we hear that a vaccine is coming from Pfizer. There are probably 10 to 11 further vaccines coming over the next 2 to 3 months, and we may well hear from AstraZeneca in the UK, the Oxford study, in the next 2 to 3 weeks. But this will be a game changer really for markets, and we've seen that response already in the last day or so, with a very strong rebound in markets that a vaccine of this efficacy is very significant to break the cycle of COVID infections. Europe, as we can see from page 79, has been particularly badly hit in terms of the economy because of the intense lockdowns that have happened there. And that's reflected in some of the data with a very savage fall in the spring in their economies, but an equally sharp bounce back through the summer and autumn. And the question is whether that trajectory then continues to rally as and when the vaccines are in use and economies then recover as the lockdowns are relaxed. The US has had a far better economic period than Europe, far less a severe downturn, but arguably they've been much more relaxed in how they've dealt on a federal basis with the dealing with COVID and the lockdowns, and hence their numbers are somewhat worse. Page 82 summarizes the global position. It was clearly looking very dire in March and April, with a 20% contraction around the world in terms of economic growth. And that arguably could have turned into a really nasty depression. And that's why the authorities were so aggressive with their monetary stimulus and fiscal stimulus. And you can see that essentially the V-shaped recovery in economies as we've moved through the summer and into the autumn periods. And I think most projections now suggest that the lost ground that we've seen in 2020, we should be exceeding the old peak by 2022. And assuming the vaccines are as successful as we expect and hope, then it's perfectly realistic to expect economic growth to be accelerating through 2021 and into 2022, and similarly corporate profits following that economic growth upwards. And that's no surprise to us, therefore, that markets are rallying as we speak very aggressively. Just turning to one of the other major things to consider, particularly from our fixed interest exposure, and that's global inflation expectations have recovered and almost certainly will go somewhat higher as the reflationary trade of economic growth recovering begins to pick up. And as you can see, the UK with inflation, these are market expectations of around 3%, possibly accelerating up to the 3.5% as we go through the next 18 months to 2 years. But generally there is a slight up inflationary bias to markets due to the very, very aggressive monetary stimulus that we've seen over the last year. I'm not really going to focus too much on the Trump versus Biden policy comparisons, as we've heard a lot about it in the news now that we know Biden is president-elect. But I would emphasize there is a clear difference in Biden's stance on infrastructure spending, and in particular on green energy, and that fits very well with the desire of the investment committee to focus on environmental issues and greenhouse gases in particular. So I think there are very positive things to come out of the Biden win. And I think that will present very good investment opportunities for us going forwards. Not least, it's possible that the relationship with China will be less tense, and that should therefore also make economic growth that much stronger going forwards over the next couple of years. Just one final point, and I think I've referenced this in previous meetings. The thing that does concern me is the level of debt, both at the government level, both at the individual level, and at the corporate level. Debt, of course, as you know, is incredibly cheap. In fact, in many areas, it's virtually at zero, and in some areas of the world, it's negative. And people, countries, corporates, people are taking on a lot of debt, and there is a risk to the structure of markets because of that. We don't think that we're at the onset of a major bear market downturn as we were in March 2000 or in October 2007, but there are quite a few warning signs beginning to flash red now, and we need to be aware of the positioning of the portfolio, and quality is very much the watchword in the assets that we buy. And while it's very obvious there is a dash to trash that we're seeing in markets as we speak over the last day or two, we certainly don't want to be suckered into those stocks, which almost certainly will prove to be fool's paradise. And we stick to the good quality names that over time will deliver the sort of returns, the 8% plus returns that we've achieved over the last 11 years for you, and where income growth above the rate of inflation will remain paramount. That, I think, concludes from me.
Okay.
Thank you very much, Charles. And I'm sure that councillors have got no shortage of questions to ask you, but I'm going to ask Nick to present first, and then we'll sort of go around the table metaphorically, and councillors ask you jointly, and you can choose which of you answers first.
Okay.
So, Nick, would you like to go ahead, please?
Good evening. In terms of what I'm going to discuss, I think, as is usually the case, we tend to have relatively similar views about the major factors affecting the market. So I would suggest that I'm going to try and focus a little bit more about on the portfolio and the repositioning of the portfolio, not because I don't have an opinion about the market, but just because it's broadly in line with Charles's. So while the portfolio has recovered significantly from the low points at the financial year end, the overall total return for 12 months on the portfolio that we manage for you has been relatively disappointing at about -6% on a total return basis. That's on a trailing 12 months to the 30th of September. I would note that it's recovered more than half of that in the period since the 30th of September. But as Charles pointed out, I think there are threats to the rally we've seen recently. And so I would be keen not to count too many chickens before they hatch. Main reason for that's been the shift towards more income-focused assets over time. At inception, and the timeline for this portfolio is considerably shorter than the portfolio Charles manages, just because it's something that we've had for coming up for 4 years now. At outset, the portfolio was yielding a bit below £60,000, about £58,000 in a year. We've been moving to try and close the gap income-wise between this portfolio and the Investec portfolio. We're pretty well there, but what of course that does mean is that we have been repositioning towards more income-producing assets, and over the last 12 months, it's been income-producing and value-based assets that have borne the brunt of the market falls. However, we are fairly comfortable that good quality assets will prove out over time. A lot of that repositioning has been not so much towards income-producing equities directly, but to asset-backed vehicles, which have seen markdowns throughout this year, but ultimately shareholders' positions are much better with those asset-backed vehicles, provided the underlying assets are of significant quality, which we're comfortable they are. So we would expect those to be well positioned to continue recovering going forward. In terms of the asset allocation at the moment, the UK direct equities asset allocation in the portfolio is relatively modest at about 16.6% at the moment. The reasoning for that is partly because of a degree of cynicism about whether the UK has a relative competitive disadvantage economically for the next few years, a desire to have a fairly hefty overseas exposure, and also the fact that with a cautious mandate on this portfolio, the weighting to fixed interest is somewhat higher than one would pursue with a more adventurous attitude to risk. Within that asset allocation, the overseas weighting, I would point out something that was scratching the surface with the idea that the US economy is powering ahead. For the first time in 42 years, 5 constituents in the S&P 500 account for more than 20% of the entire index. If one strips out holdings in Apple, Alphabet, Microsoft, Facebook, and Amazon, the grim reality is that the majority of constituents of the S&P 500 are down in 2020, and there is a degree of economic pain. I think the resolution of the American election will help with that, but as Charles quite rightly pointed out, the overriding issue is that debt is high. We're seeing sovereign debt, government debt rising to deal with this. And so it's going to be very much a case of having to pick asset allocation very carefully. One of the key things in terms of asset allocation that was highlighted at the meeting in February was a desire to improve the ESG credentials of the portfolio. At that stage, about 7% of capital and 13% of income was derived from fossil fuel related investments, both due to changes in the value of holdings and alterations to the portfolio. We've seen those figures turned on their head somewhat. Fossil fuels now represent something in the order of 3% of the capital value and 4% of the income within the portfolio, on the basis that we are moving towards the stated desire to avoid fossil fuels as a direct investment entirely. And also note the comments about gambling, mining, chemicals and tobacco. At the moment, the total exposure to fossil fuels and mining is in the order of 5.2%. Effectively, there is a holding in Rio Tinto, which is pretty well the entire direct exposure to mining, and a holding in Royal Dutch Shell, which is about the only remaining asset directly in fossil fuels. Within the portfolio, we've also been looking at positive screening in relation to things that we think tick the right boxes for the council's policy, renewable energy, social housing, etc. And the capital allocation to those throughout this year has risen to around 20%. And they now account for about 25% of the income generated from the portfolio. Over time, we would look to continue to raise those numbers. Having also, while we don't report using Sustainalytics, I have run the direct equities component through to get a comparative figure to InvestX, which Charles was presenting and saying it rates, his portfolio rates at about 22.5 and scores medium. Likewise, the portfolios within the boundaries set by the council's investment objectives currently scores fractionally higher than the Investec portfolio at 25.9, but still within the medium category. And like Charles, there are no holdings that would rate as severe. Effectively, there are two that rate as high, which are those two that I previously mentioned, but on a weighted basis, scoring still within the medium bracket. The key thing for a lot of people, the council included from a budgetary point of view this year, is income. And as I say, historically, this portfolio yielded significantly lower than your other portfolio. While that was brought up to be pretty well on a par this year, has seen falls in income. The fall in income is of the order of 15% on this portfolio. It still yields 20% more in absolute terms than it did 3 or so years ago. But I think that that erosion of income has pretty well dried up now. The situation earlier in the year was that I got 3 emails a day updating the list of companies that had said they were passing or cancelling dividends. And I now get 1 a fortnight. And we've also seen a number of companies start to say that they are in a good financial health, that they can afford to pay dividends, that they intend to reinstate dividends. And in some cases like Synthoma, which the council has a holding in, that has already been penciled in. In other cases like HSBC and so on, companies have said that they will pay dividends as soon as the regulators allow them to. The banking exposure in the portfolio is relatively minimal. but for the foreseeable, that sector is going to be precluded by the regulator from paying dividends. The majority of the dividends, however, are increasingly coming from both the fixed interest and alternatives space, where, like Charles, we have been increasing the allocation to infrastructure funds and renewable energy, and those have a degree of exposure to electricity prices. So some of the net asset values in those areas have been a little bit soft, but the income continues to flow. We haven't seen dividend cuts in that area. And so I would be optimistic that the worst has passed in terms of rapid deceleration, falls in dividends, and that we've got a lot more visibility now going forward. I think the likelihood, however, is that equity dividends, just like in the credit crunch, will take some time to fully recover their previous levels. In terms of factors, the factors from my point of view going forward remain very similar to those that Charles has identified in terms of COVID-19 will always be there until we get, as an uncertainty, until a vaccine is not only developed, as we've seen news on, but rolled out. Economic recovery more broadly, and the levels of government debt that we're left with after this resolves itself will mean that this will continue to have an impact on markets for some years to come. I think, however, that it is going to always be the case that the portfolio is now positioned more towards the new economy and a greener economy, which will play a part. And it's been a statement from most Western governments that they envisage those sorts of areas being very much at the forefront of the rebuild economically. And the quality assets, as Charles said, will be very much a key in an uncertain world going forward. I think that pretty well sums it up from my point of view. And as with Charles, very happy to take any questions.
Okay, right. Thank you, Nick, and Charles before him. So I know there are likely to be a lot of questions, and I would like councillors to restrict themselves to a single question. Otherwise, we are going to be taking a very long time to get through this meeting. I'd like to start first of all with the accountant and the town clerk, if they have any questions on those presentations before I go around the table of councillors. Would you like to ask any questions now, either of you two?
I don't. Oh, sorry. I was going to say I don't really have any questions. Just to thank them for the presentations and say I thought they were very comprehensive. Hence, I don't really have any questions.
Liz, do you have any questions?
Mine really was mainly the projected income for the next year or so, because obviously we're looking at our budgets at the moment and predicting I think about 150,000 between you, roughly equally now, which is great. Given the sort of the good news that there's been and the good news that you've been getting from the market generally about dividends becoming reinstated, do you still feel that those are about the right levels of income? So we're still looking at around about 150,000 for next year?
I think that it's likely to take some time, because bear in mind, companies are not necessarily going to reinstate dividends at the levels they were at prior to them passing on them in March and April. I think a lot of companies will investors will be pleased to see them return to the dividend list full stop. They will start with lower dividends, and we're going to be looking at a situation of them rebuilding over time. So I would suggest it may be wise to take a relatively prudent view and to regard any acceleration of dividend resumption as an extra or a nice thing to have, but I certainly wouldn't budget on it.
Right. Thank you.
And I would entirely agree with Nick's view, and it's better to be prudent rather than raising your expectations.
Yeah. So the figures that you gave me for expected income are fairly conservative?
Yes.
Yeah. Okay. Thank you.
Okay, thanks. Yes, that was a useful thing to get clear, and given the later agenda items. I'm going to go around the table in the order that they appear on my screen. That means that Councillor Gavashak starts off, and the order, if you're interested, will then be Councillor Hamilton, Thomas, Hillier, Plant, Arlott, Romans, and Hinton. So, Councillor Gavashak.
Okay, thank you. Thank you, Chair. Stefan here, and Charles, you must be extremely pleased that you don't have to have the journey up to come to Henley, although you're enormously welcome. And but thank you for your full reports, and also Charles and Nick, you're wise to be prudent. You mentioned earlier about not divesting too quickly from the fossil fuel arena. And I'm glad that we're in your hands. Anyway, I will move on to my questions or question, as Ian has said. Can I just? I am going to roll in two questions, so I'll be quick. Inflation going forward, does that mean, you mentioned 3%, 3.5%? Does that mean interest rates are going to rise in order to actually put a lid on inflation, and that might affect income? And secondly, are you looking below the skin of some fossil fuel companies? For example, Shell have an arm which is completely renewable. So therefore it falls into our good category, if you like. So I will stop that, and thanks to Ian for allowing me to pop the questions. Thank you.
Can I start with that, Charles?
Yes, of course.
The two things, yes, ultimately inflation will be, as Charles's graph showed, the expectation has resumed. The endless expansion of government balance sheets of government debt will ultimately prove to be inflationary. In terms of how quickly, I suspect it will take a little bit of time to manifest itself. It's not going to appear in the next 6 months or so. The markets are always looking much further out the yield curve when it comes to where inflation fits in. So yes, it's going to be a consequence of this, but it's not going to be an immediate one. In terms of looking beneath the skin of things, absolutely we do. But I think the council's investment policy is fairly black and white, in that there are certain sectors that it is writ large that the council does not wish to have direct investment in. And therefore, the fact that there are elements in most companies that one could view as a saving grace, I think realistically, for so long as the majority business for people like Shell remains in hydrocarbons, then I think that would preclude further investment there. I mean, I think the fact that the council, I think the acknowledgement of the silver lining is in some of these businesses is that the council haven't said they want to immediately divest of those things, to acknowledge the fact that both the fact that the council wish to exit these things at an opportune time, and also the fact that these businesses are developing on an ongoing basis, and there may be a point where they become more palatable again. But at the moment, I would consider myself precluded from buying anything directly in those fields that are identified in the investment policy document.
I would concur with Nick's view on inflation. I don't think it's going to come back with a vengeance in the next 6 months or so, but I think the sheer amount of money creation by the central banks could have an impact on inflation in 18 months to 2 years' time. Most of that monetary stimulus has gone into financial assets, hence that's why stock markets and bond markets are relatively high. But in time, we do think it will feed into to inflation to some extent, but we're certainly not going to go back to levels of inflation that we've saw, for example, in the 1970s and early 1980s. So inflation will remain around the 3 to 3.5%, possibly 4% level at the top over the next couple of years for the UK, and somewhat lower than that for the US. Regarding the question of moving out of carbon assets, I think it's a difficult question for us to get the timing right. I think, as I put in my presentation, it was better to go more slowly and not throw the oil stocks out too quickly, because nevertheless they do provide a lot of income in an environment when income is scarce. And I don't think you would have thanked me as a council if your income had dropped substantially from the level of about 80,000 to back towards the 65,000 level. I think that would have caused more problems for you if I had acted on the mandate to reduce those bad sectors too aggressively.
My next in.
Councillor Hamilton, yeah, go ahead. Sorry,
Yeah.
I hadn't realised I was muted.
Thank you. Thank you, Charles. Thank you, Nick. My one question in order to satisfy the chair is what we invest in. But I'll round that off by saying to really a further point between the good, the bad and the ugly. There are clearly some good companies, there's some bad and some very ugly. And I noticed, Charles, there's still British American Tobacco on our portfolio. And tobacco, in my view, is very much more than an ugly. I see the prudent approach you've taken. I welcome that. And I see absolutely in terms of keeping our income up, yes, we probably would have been a little thorny if we had kept to our mandate, as it were, and not allowed you to deliver the 80K. I just wondered also, is there any ranking between a BP share and a Shell share, along with Stefan's point about, they're maybe now becoming better shares because they're investing in renewable energies going forward. And I per se don't want to throw the baby out the bathwater in terms of the fossil fuels. I go on to just if I'm allowed a second question, Chair. We have drawn best part of 357 grand of drawdown, as it were, this year. And perhaps as a council, we should be thinking of, given debt levels at zero, interest levels at 0.1%, perhaps what we should be doing, given the performance that you're giving us, is thinking more about drawing down less, but taking some debt on at a 0.1% in order to finance some of our other activities, because clearly the return you're giving us at the moment is rather special. And I'll leave it like that.
Will, shall I just respond on the question of cigarettes? BAT is very much on my radar to be chopped from the portfolio. You probably saw that earlier in the period, back in February, I think it was, I took money out of it at about £33 a share. It's recently dropped back to £24. It's rallying, or has rallied in the last few days back towards £27, and it's very much on my radar to come out of the portfolio soon, but I can't say exactly when, but it's definitely coming out fairly soon.
If I can just follow up then, are there any other vaccine companies that we should be looking at, given we've already got AstraZeneca?
Oh, vaccine companies. Well, there are 11 or 12 major vaccines in the pipeline over the next 2 to 3 to 4 months to with their results. I think the answer is the majority of there's the French company Sanofi, there's Eli Lilly, the American one, Moderna, etc., etc. I think we're capturing some of that through the health fund that we've got, the Polar Cap Global Health Fund. They will pick up some of those beneficiaries of that. And then, as I say, things like Croda, which is supplying some of the specialist chemicals that are going into the Pfizer vaccine. So there are different ways of playing the exposure to that. Don't forget that a lot of these vaccines aren't necessarily going to be profit centers, because companies have agreed to do them essentially at no profit initially to governments to help out with the fight against the coronavirus. So they won't necessarily be brilliant investments from that perspective straight away.
Thank you.
Right, Councillor Thomas.
Thank you very much for your presentation. It's absolutely fascinating. I just wanted to know, I wanted to get an overview of the risk spread across our portfolio. I'd just like to know what percentage roughly is low, medium and high risk. Thank you.
It's, I think the easiest way to view it is as a whole, because both ourselves and Investec use effectively the same product for measuring volatility. Because Charles, you guys still use BITA, don't you?
Sorry, I couldn't hear you, Nick.
You still use BITA, don't you, Charles?
Yes, yeah. We do. Yeah.
We use the same sort of software for managing the portfolio in terms of its volatility and so on. So it's not a case of assets go in a bracket that says low, medium, bucket for low, a bucket for medium, a bucket for high, and so on. Every single holding is weighted. And so, for example, I could hold something that is relatively conservative, but if I'm holding something else that has a degree of overlap with it, or a replication of exposure across the same markets and sectors, the risk for both of those will be raised to reflect the fact that they overlap. So, for example, if I look at the current portfolio at the moment, I might have a holding that actually in monetary terms represents a higher percentage of the portfolio, but in risk scoring is much more moderate, just because of the nature of the underlying investment. So Charles's portfolio is managed on a medium risk mandate. Ours is managed on a cautious risk mandate. And that's the only thing I would say about that as well, is the industry does not have a standard definition of risk. The regulator does not say this is what is medium, this is what is low. Every firm produces its own definitions and boundaries for what's low or cautious, what's medium or moderate, and so on and so forth. So it isn't, it's not easy to turn around and say 28% in low risk or X% in medium risk, because it's about blending the overall portfolio to meet the client's stated attitude to risk for that mandate. Sorry, that's a bit of a roundabout answer, but what I'm trying to say is there isn't an easy answer to your question.
Thank you.
It's only because if I have loads of similar low risk investments, that would be high risk.
Yeah.
There's an alternative way of looking at risk, and risk means different things to different people. So it could be, which Nick has described, as a measure of volatility and how much things move up and down. I would pose it more as, do I perceive there's anything in the portfolio where there is the likelihood of a permanent loss of capital? That, to my mind, is risk. There is nothing in your portfolio where I think there will be permanent loss of capital. So under that definition of risk, I don't think the portfolio is particularly risky at all. I would argue it's towards the certainly medium risk or lower medium risk, because I don't think there's a single company or holding where we're going to have a permanent loss of capital. That's why I was trying to emphasize in my part of the presentation, it is very important to focus on the quality of assets, i.e. ones which won't default and let you down. What one doesn't want to do is get caught in poor quality things that optically look attractive, but actually are fundamentally weak businesses, and that would be a risk and a permanent loss of capital. That's what we're trying to avoid in the construction of the portfolio.
Okay, thank you, Charles. Councillor Hillier.
No, nothing from me, and good to see you both again, and thank you for your presentations this evening. It was great. Thank you.
Right, thank you for your speedy question, Lorraine.
No.
Councillor Plant.
Yeah, just really quick. Thank you to you both. Great presentations. Yeah, Stefan and Will, same discussion we had at the start of the year when we kind of discussed coming out of the holdings that we did have, is that there's always an element to which they are big investors in going, carbon neutral. You only have to read BP's report to say that, by 2050, they want to be net zero carbon neutral and invest in the world becoming green. So kind of go figure, as it were. But yeah, just kind of an open question. Is there anything that we're missing or should be doing, or that either of you would advise us to potentially consider in a period where dividends are maybe going to be low for the next couple of years potentially? Is there anything else that maybe we should consider growth-wise to then return better dividends in years to come? But I'm a layman, so your kind of expertise on those ones.
Nothing springs immediately to mind. It's not a mandate where I think I just wish they would loosen the reins on this or that or the other, because it would dramatically improve outcomes. Because I think the reality is that there's an element in these things of once you've got the income you need, if it isn't broke, don't fix it, because there's very rarely a magic bullet which says if I could just do this, then the results would be dramatically different. So not that springs to my mind.
Perfect, thank you.
And I would concur with Nick's view, and I believe we've got enough latitude in terms of restrictions placed upon us. One that might be a consideration is the 35% exposure to international markets, and arguably it might be worth considering whether we were able to go up to 40 or 45%. If, which I think Nick referred to, if we take the view that the UK market is not going to return as good returns, both in terms of capital and income, as other areas, international markets, which have higher systemic levels of economic growth, partly due to technology, such as the US market. And that would be one area, but broadly, I think we've got enough, as I say, tolerance and latitude to deliver the sort of returns you're expecting.
But if that's something that you feel would be useful, then I'm sure that's something that we probably should consider. Then it's a small percentage change.
I think it would be useful. But I don't feel constricted by the current ceiling of 35% in international stocks.
Just to remind councillors, the second half of this agenda item is to approve the council's investment strategy, which includes that figure. Councillor Elders.
Yeah, I'd probably just make a statement rather than a question, unless anybody, either one would like to answer my statement. But, Councillor Hamilton mentioned about, maybe chasing, vaccinations. This is obviously, everybody will probably try and plough into that. And I can remember back in the year 2000 really well. I'd just come back from New Zealand and everybody was ploughing their money into IT. And within about 6 months, it just about crashed completely. And, well, it's not a question, it's a statement, but if you want to answer, I don't think we should plough everything into vaccination, because there's going to be some winners and there's going to be some losers. And I'd hate you to chase the losers.
I think if we happen to have money in businesses, both Charles and I putting words in his mouth, but I think if there are companies in the portfolio which meet all the other criteria we've discussed about the quality of the business, the security of its revenue streams and so on, that happen to be involved in those areas that are driven by short-term news flow, like vaccines or whatever, great. We'll take the markup on the share price, but I don't think we're either of us particularly likely to go out looking for, hunting for it in response to short-term news, because the mandate from our point of view is that the time frame for the council's investment is open-ended, and it's not a short-term exercise from your point of view.
Okay, Councillor Romans.
I don't have anything to ask which would add to this.
Okay, Councillor Henson.
I don't have anything to add. Thank you again. I find these one of the
Kelly,
most
we can hardly make out what you're saying.
Meetings of the year. So thank you.
Kelly, we could hardly.
I don't really have anything to add. Can you hear me now?
Can you turn your video off and then you?
I don't have anything to say anyway.
I think we can make out that was thank you very much, and I don't have anything to add.
Yeah, I think you just have to disable your video when you're speaking, Kelly. When you were making your presentation, I did sort of write down Brexit and underline it, because it would have been a long shot at the start of the year if we'd have expected you to make this presentation and not feature that, or hardly feature that at all in your guidance to us. It having been the sort of major dominant issue for the last 4 years. And I think that there was a good point made by Charles there, which is that the UK market is certainly liable to have less certainty about it than perhaps other markets. And the suggestion that we consider raising our limit on the world markets, I think it is worth us doing. As I say, the approval of our investment policy is coming up, and that's where we state that. When you made your comments, Charles, yours were rather guarded, but I think there was a clear point. And Nick, do you feel similarly?
I feel similarly. I mean, I think that the reality in both portfolios is that even the UK equities that are there primarily earn their money overseas. So what comes, everything has to go under a heading somewhere. And so a UK domiciled business that's listed in London will end up being categorized as UK equities. I think for both of the portfolios, the vast majority of the actual earnings come from overseas. In the portfolio that we manage, there is a reasonable amount of UK revenue, but the vast majority of it is from either asset-backed fixed interest or alternatives. In terms of normal direct equity exposure, they earn fairly modest amounts of money in the UK. But that doesn't change the fact that an adverse outcome in terms of bumping onto WTO terms could just see the general rating and valuations applied to UK listed equities discounted compared to global equities. So I think the capacity to have the flexibility won't hurt. the decision about how best to use that flexibility, I think, one will have to wait and see how things play out. But it certainly wouldn't be a bad idea, given the fact that the same principles would apply whether one was increasing the overseas equities weighting, about the quality of assets and quality of income streams backing it.
You sounded as though you weren't. You felt that limit wasn't imposing restrictions on your ability to invest our portfolio in the way that you think most advantageous.
I have a bit more headroom before I hit the current threshold than Charles is the only reason it possibly is less pressing from my point of view, but only because we carry a higher fixed interest and alternatives weighting to Charles. So it's not that I necessarily have a different view as to the relative merits of overseas economies compared to the UK economy. It's just that I perhaps have a little bit more headroom in the existing asset allocation than Charles does.
And it wouldn't be an instruction on our part, it would just be a removal of a restriction which you wouldn't necessarily have to go beyond anyway.
Yeah, and hence my comment about having the flexibility is never a bad thing. How one implements it or uses it would be based on best judgment at the time. Yeah.
Okay, I'm going to wind this up now. I think we've gone through most of it. Are you going to be brief, Stefan?
I will. It's really just going back to Charles, because I mean, Charles and Nick are the experts on this. If we are going to modify our investment policy, and it certainly seems, from my point of view, we should. I mean, Charles, you mentioned increasing it to 45%, but both of you, can you give us your best advice on where you think it should go? Of course, we trust you not to use it if you don't want to. But I think we, as a finance committee, should be advised in order to make a sensible decision.
I think looking at the expected future returns from different asset classes and different countries and different sectors, I think it would be sensible to raise the limit. I think my advice would be to go up to 45% in international exposure. I think, as we both have said earlier, we wouldn't necessarily go to the limit, but I think having that flexibility would make sense. There is, of course, always the risk from the currency going against you, and obviously you need to spend pounds sterling. So if you're deriving a good proportion of your income, let's say from dollars and euros, and then converting to sterling, one has to take that into account in terms of the income flow. But I don't perceive it to be too high a risk. And I think the rewards, as I say, over time will be better because of the much greater potential growth, both in terms of general economic growth from the US and Europe, particularly in the light of Brexit, and also the companies operating in those geographies, which although, as Nick says, the vast majority of the companies we invest in the UK, in the portfolio, actually are deriving their income from international markets anyway. So it's slightly a misnomer that they're UK companies. They just happen to be domiciled here. But yes, I would advise the committee that up to 45% would be a perfectly reasonable ceiling to consider.
All right, thank you, Charles. That's I'm going to cut it off there because I think we've had an excellent presentation, had covered a range of the questions that arose out of it. So thank you very much, Charles and Nick. And can I just make one point about the presentations, which I thought were excellent, clear, but we are particularly focused on the ethical investment strategy, and a clear presentation of the nature of our ethical investments next time. I think you'll be doing another report in 6 months, won't you? It would be very helpful if you could, I think, present that as clearly as possible, so that we understand what our percentage is in fossil fuels and other areas that we probably don't want to be investing in, as well as the ethical standard rating itself. Okay. Right. Thank you. You're welcome to stay and watch Charles and Nick, but please disable your audio and video, and we'll thank you for you again, and we'll see you soon in 6 months' time.
Very good. Thank you.
Thank
Bye for now.
Thank you.
Okay, we now move on to 5.2, which is to receive reports on the council's investments and to reapprove the council's investment strategy. So with that, so let's first of all look at the reports of the council investments. So, Liz, would you like to say anything about this?
I think it's straightforward, and you know, there are various schedules showing, you know, what our current investments are, what the headline figures are. I'm hoping it's fairly self-explanatory. So the only suggestion would be to change the recommendation where we approve the investment policy, just to say, if councillors wish to increase the maximum amount of overseas equities to 45%. At the moment, it's 40.
Okay.
I was trying to find that in the document, but
it's on page 49.
Right. Thank you.
Point, first paragraph, point B.
Councillor Hamilton.
Yeah, I would like to propose that we do move that to 45. I've listened to both Nick and Charles, and I think it's a very sensible thing to do. I think I'm not saying they should use right up to the 45%, but I think given the advice we've been given, it's right that they should have that limit should they wish to go into it. I would also make the point, in the next 12 months, the markets are going to be hugely volatile in my view. And whilst we've set a direction of travel for the investment managers to move away from some of these fossil fuels and move into more well, nicer to the environment type companies, shall we say. I do think that, yes, we should set that mandate as a direction of travel, but they should use their sense and ability, as it were, to not move out of these shares quite so quickly if they feel that's the way that we should be supported.
Well, I think the form of wording we've got on page 49, which is little point little I, to work towards zero holdings in the following industries: tobacco, chemicals, mining, oil, gas production, and gambling. I think that continues to cover the directions that we should be giving very clearly. Councillor Gamshaw.
Well, I will second Councillor Hamilton's motion to uplift from 40 to 45. We've had the experts, you know, Nick and Charles, actually giving our advice to give them extra flexibility. It's certainly my reading that certainly in the near term there will be more investment opportunities in Europe and the USA. That's not wishing to downgrade the UK economy, but I think there are problems looming for that. So we have the duty to manage the council's money to the best of our ability with the advice we've been given. So I happily second Will's motion. Thank you.
So we have a proposal, which I think is to approve the investment policy, but with the 40% change to 45%.
Right.
In section 4, little b. So that's the proposal. Does anyone else wish to speak to that? Okay, all those in favour of that proposal? Okay, thank you. Okay, that's the end of item 5. Item 6, reports of working groups. So the value for money report is on page 91, and the notes I think were helpfully clear and straightforward. I don't think anything specifically arises out of that. Councillor Hamilton.
Yeah, just a couple of points, if I may, Mr. Chair. I note that this meeting met on a Monday at 2:30, and Councillor Plant's on this one, not me, so he would have been there if he wasn't working, but he was working. I would have been there. I would have subbed for him if I wasn't working, and I'm sure Councillor Hillier would have been there as well. I just think for the Value for Money Committee, perhaps it should meet in the evenings. It only meets once a year, importantly, and I think the work they've done, incidentally, is very good, but I just request next year perhaps that meeting should happen at a more amenable time, given availabilities. I note point A. I think personally, is too little a. I think personally that whilst this year is going to be difficult in terms of the deficit, in terms of the precept setting, I would very much hope that we could possibly take that money from reserves rather than putting it on the taxpayer this year. But I note the point that's been made. Look at little point I, which is the Mill Meadows parking, which is a point I've already raised before in terms of the parking income. And I hope that we could do something in that area to raise some income, some revenue generation. Point little k, absolutely support. And point little n, I just want to make sure that comes back to committee. It's not just the SMT, as it were. But those are the only points I make, and I'm pleased that the Value for Money Committee has met and come up with such good points.
10 Clark, I think you wanted to respond to that.
Thank you. It was simply to say that the budget is an agenda item coming up later. So the discussion of those items is probably best suited to that agenda item.
Okay.
Okay, can I propose therefore that we note this this report? Second for that. All those in favour? Okay, thank you. Item number 7, expenditure. So we have some details of grants and other spending plans we need to do. So first of all, little I, the Headway Music Therapy grant. They wish to vary the way in which the award of this grant was made, or the purposes to which it's to be put, because of the changes forced upon them by COVID. And it seems to be an entirely reasonable proposal, unless anyone wishes to suggest otherwise. So I'd like to propose from the chair that we do vary the grant conditions as requested.
I'll second that. I'll second that. I think they do. I think that Headway do fantastic work, and any way that we can help them, we should.
Okay, all those in favour of that proposal? Okay, thank you. Next, the neighbourhood plan, £8,000 from SIL for publicity costs. Deputy Clerk, do you want to speak to this?
Yes, I would like to speak to this, please.
Right, go ahead.
Thank you. Since 2016, when our neighbourhood plan was made, and looking forward, Henley Town Council will be receiving in the region of £500,000 of community infrastructure levy funds. And in discussion with the planning officer, looking forward at the costs we have coming up, the Neighbourhood Plan Committee would now like to, or the officers would now like to request that some money is set aside towards community engagement activities, public consultation, and the design of the documents that we'll be hoping to bring out to public consultation next spring, and that in reality up to £8,000 is set aside from our SIL monies towards that, together with the next item, money for conservation area assessment. We have received a lot of funding from, or we've made a point of applying for the funding that we can apply for from SOGC and locality, though there are some monies still outstanding that we can apply for from locality. And we've used several technical packages from locality for site assessment, housing needs assessment, strategic environmental assessment as well. And this will equate to several £1,000s worth of consultancy. As we're now finalising the stages on the neighbourhood plan, and we've also obtained the promise of some funding from Harpston Parish Council, towards the consultation and marketing costs. It would be useful from the project point of view to know that we've got some funds available within the town council for this work. That's all I want to say on this item. I have got a bit to say on the conservation area assessment.
Okay. Councillor Thomas.
I'm just wondering how our new comms manager will be involved in this process.
I've had an initial meeting with Naomi today, and she's going to have a separate meeting with Jodie. She's looking over the survey that's about to go out shortly, and is going to prepare a press release so that we can advertise that appropriately. And I've put in her diary, as it were, that we'll be looking at to go to public consultation next spring. I think Naomi will obviously be able to advise us on this, but there are items. One of the things we were discussing, and I don't know whether we will need to do this, but we'd like to have an in-person public consultation on the sites for development. And one of the suggestions is possibly we might need a marquee or marketplace to be able to do that, to enable us to have some fresh air and enable people to attend rather than actually doing it inside. And that in itself, will bring some costs. Also to have the documents professionally laid out. I had quotes that varied from £2,000 to £6,000 for that. So until we've got a definite document to get laid out, then I can't tie that down anymore. Even just to advertise in the Henley Standard, the last advert I put in with regard to our developer presentations, that was £350. None of these things come cheaply, and there are costs that not just our new communications manager would be able to cover for us, as it were, do the work instead of paying out for it.
Councillor Plum.
I was just going to say, I think both Little 2 and Little 3 are, common sense and practical uses of SIL money. So I think it's straightforward approvals to both of them. I know we haven't yet heard the conservation area one, and I'll let Kath talk to that one. But this is what SIL money is there for. We've looked at different practical ways that we can use it for salary costs, etc., etc. This is straightforward.
Councillor Gavin.
Lawrence, if we stick with 2, if that was a proposal, I will second it.
Yep.
Okay, so
proposal then.
Yep.
I would just like to say before we vote on this, I'll come on to you in a moment, Councillor Hamilton, that I think when the first neighbourhood plan was done, we did spend quite a lot of money on the publicity, and I'd like to make sure that given we are running at a significant deficit, that even though it's still money, it still remains public money that we should look after carefully. And I'd like to be certain that the money that we spent is good value for money and remains so. But I will vote for the £8,000, not because we're necessarily going to spend it all, but just simply so that those who are running the neighbourhood plan can do their job and get the publicity right. Councillor Hamilton, did you have something to say?
Yeah, I too would support the 8,000 because they need some money to do it properly. I just asked that they use the old map holder and that kind of thing, and the old weights and all the other equipment that was purchased last time as part of the process. I do just question something. The mayor went to see Harpston and came back with a cheque for 31,000 recently. That was for Harpston SIL money. I just wondered whether the mayor could go back to Kester and ask him for half of the publicity costs, 4,000, whether that possibly might, he'd like to give it another go.
Have you tried getting money from Kester?
Well, he did well last time. I think she send it back out.
Give you a brief.
I think the deputy clerk has got some. I can respond to this one.
Harpston, the 8,000 is our half. Is Henley's half of the.
So it's 16 in total.
The anticipated marketing and public engagement costs.
Well, it's quite a lot of money.
Already committed 8,000.
Okay, can we move on?
And anything from Shiplake?
We move on to a vote, please. All those in favour of the proposal? Okay, thank you. The conservation area assessment. Deputy Clerk, you wanted to speak to that as well?
Yes, this is really Jodie's area rather than mine. But I think she has set out in the report that went to Neighbourhood Plan Committee in section 2 what the benefits are. And as ever, as part of the reason we're reviewing the neighbourhood plan is that it's better to have a more recent neighbourhood plan. Our current conservation area assessment dates from 2004, so is well out of date. And I think it would definitely benefit us to have this brought up to date. With regard to the costs, we approached Historic England, but were unable to get any funding from them. Jodie is investigating alternative sources of funding for this. Again, we could possibly use some of the monies that are still available through locality, and Harpston have also indicated that they would be willing to fund some of the cost as well. So that's what I've got to say on that.
Councillor Plan.
Propose yes. Again, conservation area is something that we quote a lot of times when looking at planning applications, whether it's glass atriums on the top of Sainsbury's, etc., etc. Let's put the money to what it's used for. Ken's laughing at that one, and go forward with it.
Councillor Thomas, were you going to second that? Yeah. Councillor Gilshad, do you want to speak or are you seconding?
No, Councillor Thomas has seconded, but I approve of this motion. The only thing I would say, Kath, I shared an email with you when I was on SODC scrutiny recently. It might be worth approaching SODC as we're reviewing our conservation area to actually say, can we have some of SODC's still money for it? So it's worth an approach to who was the gentleman who, anyway, the officer dealing with it. Thank you.
Okay, can we move to a vote on that, please? All those in favour of the proposal? Okay, thank you, that's carried. Lastly, the columbarium. So there's the wiring of 3,266 emergency expenditure to CapEx. Town Clerk, do you want to speak to this?
I'm happy to speak to it. Liz has been managing the project, so I'm happy to give her first refusal if she'd like to speak to it.
I'm happy for you to speak to it. I'm sure you'll be saying what I would have said. The council, we looked at the roofing. It was back in August, beginning September, where it was noted that there was a lot of problems with the roofing at the first chapel, and we agreed to go for a comprehensive basically re-roofing. Whilst they were undertaking that, they found out that the main timber ridge beam was rotting away, apparently caused by a steel pole underneath it, and condensation, and that had caused over many years. Basically, the upshot is that there's the details there in your pack, so you can see the pictures of the result. As a result, it meant that it was going to be an additional £12,000 to replace that ridge beam. Now, some of that they'd already factored into their costings, £2,500 for timber repairs. We'd also made some savings on the costings that had already been approved by reducing the amount of time they were spending on it. So we made some savings there. And so of that 12,000 or so pounds for this, the actual only overspend is £3,266. We were in a difficult position whereby if we didn't get it approved, for every week that it goes over, again, you've got another £1,500 or so overheads which are being incurred, and so it's felt that this was an emergency. We did express our strong
strong feelings of disapproval to both the contract administrators and the builders. Basically, the question was, why wasn't this picked up before? Why wasn't this factored into the original quotes that they had that they put forward? The contract administrator did bring back quite a comprehensive response that myself and Liz, I think it'd be too far to say that we were happy with the response, but we were satisfied that the response was that he'd explained it fully as to why it wasn't. But unfortunately, we are where we are with the timber ridge beam. So that work has been ordered, and all we're asking now is for the amount, because it's emergency expenditure. I can spend from the income and expenditure account up to 5,000. However, because the work is being funded through capital expenditure, which only full council and FSM have authority to spend on, that's why we're asking for that amount to be vied from the income and expenditure account to capital expenditure.
Yes, the Governor.
Yes, thank you, Town Clerk, for that. I will be proposing the recommendation for it, but I just want to ask about paragraph 3.5 in the report, which Town Clerk, you have explained very, very well, but I would have expected it to be in the report. I mean, it does say, you know, the contractor, the excess over the original quote of 77,000. Well, what is the value of the excess? You have explained it very well, you know, this evening, but we haven't got that, you know, in, you know, the excess over the original quote of 77,000 has been reduced to 3,200. And I will actually add, well done for actually sort of bashing the price down, but I would have expected it to be in the report. But I'm happy to propose the recommendation as well. Thank you, Town Clerk.
Town Clerk, do you want to just respond to that?
Thank you. So the total actual price is in the paragraph just above. The 3.4, the complete replacement of the beam with cedar wood and steel insulation works and boxings comes to 12,106.
Thank you.
Thank you.
Just a second for Councillor Gavishak's proposal. Is that you guys, Pam? Okay. And it's worth reminding ourselves that while these excess costs that we keep, or extra costs that we keep incurring, haven't been coming in front of us recently, this is all work that we would have to do anyway. It's a listed building, we have to maintain it, and therefore the repair and upkeep of the building is our responsibility. Okay, so all's in favour of that proposal? Okay. Thank you. That's carried.
Thank you for sharing our dismay.
2021-22 budget. So Liz, this is your report.
Yeah.
And I think you have.
Don't blame me. Don't blame me for the figures, though.
You get the easy one. I think you do have something to add on this because we have information from the District Council on the tax base now, don't we?
We do, yeah. So the tax base has gone up by about 81, which is the number of residences in Henley. And the higher the tax base, the more the amount that's collected can be divided. So if the Band D council tax, the average Band D council tax at the moment is £108.50 something. So with an extra 80 households, that will generate for us nearly £6,000 extra on the precept without having to increase the amount that individual households pay. However, we are going to need the precept to increase by more than that. So there will have to be a percentage in, well, it's a decision you need to make tonight, really, is how much the increase on top of £108.52 should be in order to get a budget that hopefully, well, it's not balancing yet. We are looking at quite a substantial deficit, even assuming an increase in the amount of precept. The main reasons for the budget being higher this year than it was than we were looking at last year is on Schedule 2 attached. I'm sorry, I'm just having a quick look to remind myself what page number that is. So on page 115 of the agenda, that gives the main differences between last year's budget of 99,000, budget deficit of 99,000, and this year's budget deficit of £185,000 as things stand at the moment. So I haven't assumed an increase in the precept of 31,600. But what we can say now is that roughly 6,000 of that won't cost the taxpayers anything. But in order to have more than an extra 6,000, the taxpayer will have to pay more. And then the other main factors in the increase in the deficit this year are reduced investment income, which we were discussing with the investment managers earlier on. So I've had to assume a drop in our budgeted investment income of 20,000. There are quite a few, well, staff increases, and we have assumed a 2.75% increase in salaries across the board. We don't know what it's going to be yet. It was 2.75% this year, but we don't know what it's going to be. So that is an estimated figure, and it does assume that where people are due an incremental increase, they'll get one, and that basically there'll be the same level of numbers of staff and so on. And the various other sort of ups and downs. I suppose the biggest one is Henley housekeeping projects. There've been, a lot of discussion under T&C about, for instance, new bins or replacement bins or refurbishing bins, and grouting in the town centre. So that's kind of generally considered to be something that councillors would like to do. Tree surgery as well, an extra 10,000 under tree surgery, and that's something that RNA have looked at. As a result of all the surveys we've had done, surgery is now needing to be done on the trees that the surveyors have identified. All the various things that you'd perhaps like to discuss at this meeting. Do you want me to say any more about the council tax side of things? Not sure if I explained it very clearly. Yep. You're on silent, Ian. I'm not sure if you're talking.
Luckily, we had that meeting where they explained precept really well, didn't they? And they kind of went over the fact that if we have more houses, it actually increases the amount of council tax without each house paying more. So that's really good.
Yeah.
Training works well.
You're on silent.
So thank you, Liz. I think that was all fairly clear. So the figures that are on the agenda are now out of date then, because the precept has been you have assumed an increase in the precept of £31.6 thousand, and we're going to get 15,000 less. No, we're going to get. Where's your figure?
Well, we're only assured of getting about 6,000 unless you do increase the council tax that Band D households pay.
So I'd like to propose.
Councillor Ivan.
Yeah.
Got my hand.
Yeah, I'd like to propose that that we do increase by the RPI, current RPI, the average. Band D council tax, so that will be by 1.1% to make up some of that gap. And that will make up, if you could help me here, Liz, that will increase
Well, that
648, I think.
It means that, hang on a minute. I had a, oh, here we go. Yeah. If you increase the council tax by 1.1%, then our precept would be 648,000, which is about 15,700 less than I've assumed it's going to be in my budget.
Yeah.
So it'll increase the deficit by 15,700 if you increase the amount that individuals pay in their council tax bill by 1.1%.
So the deficit would go up to almost exactly 200.
Yes.
So, okay, so I so move. I have a seconder for that.
Can I speak to that?
Can I have a seconder for that, first of all?
Yes,
Councillor Thomas has seconded that. Right, Councillor Hamilton.
We've all been through the training in terms of setting the budget, and I know what Liz has said in terms of the tax base going up by 81. The first thing is we absolutely need a balanced budget. That's key, and we can't have what we've had in the past with budgets with TBC written in them. And I'm sure we'll get there. I just think that if we work hard at the figures, we should be in a position whereby with COVID this year, we take some money from reserves and we allow ourselves not to have to put the council tax up. That would be my view. I think that is possible given the increase that it went up last year. You know, the report is here. If we work hard at the figures, we should be able to get to a balanced budget and not have to increase the council tax.
So what you're saying is that we should balance the budget but borrow from reserves?
I think we should take it.
Which are
what I'm saying is
they're completely contradictory and impossible.
No.
Whether balance the budget.
You can balance the budget, and for 1 year only, we take some money from reserves.
Hamilton, you're interrupting me. So what you're saying is that we should balance the budget, and it's now £200,000 out of balance, but we should also borrow from reserves, which is what happens when you run a deficit. So, Councillor Hamilton, that's the third time you've interrupted me while I'm speaking. So can you just wait while you're asked to be spoken to and then speak? Okay? You can't go interrupting the meeting or it'll just disrupt it. So you have suggested that we balance the budget. Well, we'll have to find £200,000 worth of savings or increased income. You've made no suggestions how that should happen. You didn't attend the value for money meeting when you were invited. You didn't make any contributions to the value for money. If you want to make some concrete suggestions on saving on saving £200,000, then you will be able to speak. But if you're just simply going to make suggestions like we both balance the budget and borrow money, then that doesn't make any sense and isn't helpful. So can we please have a sensible discussion on this? Right, Councillor Plant.
Yeah, couldn't agree more with 1.1%. Otherwise, the money is effectively devaluing itself anyway. So we have to do at least that for the money to stay static. So common sense.
Yeah. Councillor Gosha.
Clearly, because of various reasons, it's a difficult time, and I would like to actually thank Liz for her report, which is on page 103, and she sets out very, very clearly what the pressures are at the moment. That there are investment pressures going down, there are salary pressures going up, and I would also like to draw your attention to the value for money notes that we did. And it said H. The town clerk stated he would be undertaking a comprehensive spending review, which should lead to savings. However, it was felt that the council should continue to budget conservatively, and also the K, the working group, reiterated the aim of reducing the deficit and achieving a balanced budget. Look, over time, there has been an enormous shock at the moment to the system, and over time, we will actually bring the budget into balance, and we have a duty to bring it to balance. But bringing it into balance does not mean that we we don't have cost of living increases. I mean, we learned from approximately 4 years ago, when you have zero, then you are chasing, you're catching up. And a 1.1% increase means that each householder in Henley will be paying £1.19 per year per household. So we are actually being very modest. But Councillor Hamilton is right. We have got to, through the Value for Money working group and through this finance committee, actually make a commitment to actually look for savings going forward. And I'm sure we will over the next 6 months to a year. And in fact, the town clerk is mandated in a way by the Value for Money group to actually bring forward the ideas for that to happen. So I very happily support the proposal and also the seconding of the proposal. Thank you.
Councillor Hamilton.
I thank Councillor Gavashak for saying that I'm right. And I too am supportive of the points on value for money, on points I and points K and points N. And I still believe if we work together, we can get to a balanced budget. I think that's what we should. We fully understand the dire times that's been going on around us, and our income is down because of that. But if we work together, we can get there. And I very much hope we don't have to put that burden back on the taxpayer. And that's all I say. Thank you, Chair, for allowing me to speak.
We have a proposal from the Chair that the budget is approved. Oh, Councillor Arnott.
Just briefly, Chairman, it's all well and good, people suggesting nothing and going on about it. Well, he's disappeared now. But I agree with you. If we're going to put forward a view to reduce the money or the deficit, whatever, let's do it. But just to make comments for the sake of making comments, and I wasn't even going to speak this evening, it just wastes everybody's time. So I agree with you, Councillor Reisman, for holding Councillor Hamilton. Thank you.
Okay, so we have a proposal. I'm just going to very briefly reply to some of the points, which is that we don't want to run a £200,000 deficit. That's not desirable, and we need to make sure that is, over the next couple of years, reduced very significantly or removed completely. That should be our aim. Doing that now would be very unwise. We're having the shock of COVID that's affecting everyone. If we were to take £200,000 out of the town, that would just kick it while it's struggling in the face of an international virus and an international national threat. And we mustn't do that. But we do need to make sure that we do pursue the comprehensive spending review that the town clerk's going to lead, that we look at other areas for saving. We've got another cycle of committee meetings to look for further savings that we can to get that figure down. Perhaps we get it down well below 200. And it makes sense to have cost of living's increase, because otherwise we are reducing things when we need to keep our finances in good shape. So I'm happy to propose, I was happy to propose and urge you to support this budget. Okay, so it's, okay. Town Clerk, you heard something to say.
Sorry, thank you for that. Just a very quick clarification. This is for the precept. This is a recommendation to full council. Just to remind the committee that it is merely a recommendation, and it is not approving the level of precept at this meeting.
Yes, we will make the actual final recommendation as part of our full council meeting at the start of January, where we set the budget. Okay, so all those in favour of the proposal? Those against? Done. Okay, that's carried. So we now come to item 9, which is the exclusion of public and press. I'd like to thank those who have been watching online. Hope you found it interesting. But we now have to consider that the public and press be excluded from the remainder of the meeting in accordance with the Public Bodies Admission to Meetings Act 1960, as publicity will be prejudicial to the public interest by reason of the confidential nature of the business. I so moved. I have a seconder for that. Okay, Councillor Thomas. All those in favour?